Hello, everybody. Good afternoon and welcome to the show. A few minutes late this morning, quite a lot of news to digest. We've got updates from quite a few companies, as you expect, on a Tuesday. And we've got some very big share price movements. We're going to be looking at the likes of IG Design. We've got RBG Holdings. We've got McBride, Card Factory, Hargreaves Lansdown, and various other bits and pieces as well. So thank you very much for joining me. Plenty to digest. Hello to Nishad and to George in the live chat. You're very welcome. We could start with we could start with many different stocks this morning. Let's start in a relatively calm way with a stock that I hold personally. So just pulling the screen over here, and here we go. So let's start with a stock that I own personally, and I'm sure you're all very familiar with, Hargreaves Lansdown. This one, really a household name, and shares are up 5% today. A really excellent company, in my opinion, in terms of market share, in terms of profitability, consumer brand recognition, and so on. I think we did discuss AJ Bell the other day, and AJ Bell has its own sort of special features that make it actually trade more richly than Hargreaves Lansdown. So AJ Bell gets a higher rating. But anyway, this trading statement from Hargreaves today was really terrific. We've got net new business of £1.6 billion in Q3. Now, in the entire H1 period, net new business was 1 billion. So they've done 1.6 in 3 months. Of course, there is a tax season as well to bear in mind here. But look at the total assets under administration now, 150 billion pounds almost. It just keeps on growing. Net new clients is okay, fairly small, 34,000 new clients. It's only it's only a very small percentage growth. You could argue, but it's a mature business. 1.85 million active clients in total. Revenues up 6%, and I'm a very comfortable holder here. It's only a tiny holding for me, but I'm certainly open to adding to it. The chief executive points out client service. You do see a lot of people complaining about client service, on Twitter or X. People do complain about client service. But my impression is that the people who complain about Hargreaves Lansdown are mostly the most sophisticated customers, the most intelligent investors who are very demanding, to be frank, because they have extremely high standards, and that's perfectly reasonable. But I think for the average customer, Hargreaves Lansdown seems to do a very good job. You can see they've got this net promoter score of plus 48. And they've been doing a lot of work on this active savings product. And I would say that they are very safe in terms of, the regulatory position. Regulator, the FCA is very keen that brokers are paying out, good interest rates to investors and savers. And I think with the amount of work that Hargreaves Lansdown has done in its savings products and in interest rates to customers, that it should be pretty safe. You can see share dealing volumes 794,000 a month, slightly down on the last year, but it is an increase compared to the first half of the current financial year. So not a huge amount to write home about there. And we've got 12.4 billion pounds of client cash. Yeah, I'm very happy with this holding. I intend to hold it for the long term, and I'm certainly open to adding to it because it is just a small holding for me at the moment. But I don't see what's not to like here. Market cap 3.9 billion, and you see the financials here. PE ratio 12 times based on the 2023 numbers. Let me just pull up more current valuation multiple for you. Yeah, so 12 times earnings is where it's currently trading at. If you check the Stockopedia report, so pretty undemanding valuation, I would argue. And remember, the returns on capital here are incredible. 57% there calculated for 2023. Of course, the argument will be made, and it's a good argument, that without growth, return on capital employed is not very impressive. But there are signs of some growth here. We do have modest revenue growth. We do have modest growth in customer numbers. So I wouldn't say it's completely X growth, and it continues to earn those very impressive quality metrics as it grows. And we've had a very depressed period in the markets over the past year. So absolutely, I would expect things to improve now as the markets recover. So you're all very welcome to the show, to Taking Stock here on Vox Markets. If you wouldn't mind hitting the subscribe button, I'd really appreciate it. If you could smash the thumbs up as well, it would really help out the show. Let's go next to a share that's had a big move today, and we do have quite a few shares with big movements today. Let's see now. There's McBride. Where we go with? Let's do IG Design. IG Design up 35% today. So there is a theme, I think, in today's show where quite a few stocks did get too depressed, and where they're now on a big recovery swing. IG Design being one of these. They're ahead of expectations. So this company makes celebrations material, stuff like wrapping paper and gift wrap, cards, and anything you might need for a party. And I have seriously considered putting it on my best ideas list before. I think I did put it on a list of recovery stocks that I published in late 2022, because it's really just about margin recovery. This is a huge business with enormous revenues and very low margins. And the question was just, can they recover from the inflation that we had last year and the year before? And if they can pass costs onto their customers in the fullness of time, then profits would seriously rebound. So you can see this is happening today with the shares up by 35% or so, depending on which source you look at. It's a huge one-day movement. And you can see that what they're talking about in today's update is getting their margins back to where they make serious profits. So you can see they've continued to make good progress on the turnaround journey. These initiatives have resulted in significant growth in profit and margin for the year. The group expects to deliver adjusted PBT of nearly $26 million compared to only $9 million the previous year, which is ahead of market expectations. And the adjusted operating margin is expected to be circa 3.8%, a further recovery of 200 basis points on the previous year. So this is a theme that we've talked about a lot. Myself and Paul at Stockopedia, for example, we've been talking a lot about margin recovery in the post-COVID, post-inflation era. And if IG Design does get to pass on its costs to customers in the fullness of time, we will see an enormous growth in profitability. And we've already seen clearly this financial year is already seeing a huge step in that direction from $9 million of adjusted PBT to nearly $26 million. And that's just in the first year of the recovery. And interestingly, they've actually allowed their revenues to decline, which is another theme. We've seen it with the likes of AO World, I think Nichols, companies where they are getting much more sort of ruthless now. And they're saying, we no longer care about revenue growth. In a higher interest rate world, we are going to allow our revenues to actually decline if it means that we can generate decent profits. And this is working for IG Design. They've got a 10% reduction in revenues in line with expectations. So revenues of about $800 million. So as I said, this is a huge business relative to its market cap. So its market cap is only, I think, 158 million pounds. So a huge business in terms of price to sales. You get it. I mean, I think at one point they were going for $1 billion of sales. I'm not sure if, I don't think they ever quite reached $1 billion of sales, but they were going for it. And you can see that they've allowed it to decline, but with much, much better margins. You see they've got a large business in America. I think that was the business that they acquired a few years ago and arguably overpaid for it. But we've got a net cash balance of $95 million, well ahead of market expectations. Helpfully, they do say something about their average cash balance, which every company should do. So they were average cash positive for the year. Now, it would be very revealing if they said what the average cash balance for the year was, because the way that they put it there, the average cash balance might only have been $1 million, any positive number. So bear in mind that when we don't have the average cash balance, there could be very huge seasonal swings, and that is likely to be the case here. Moving forward, the cash is expected to continue strengthening due to the company's financial performance and sale of freehold sites. They make a small provision. I don't think that's very important. And then in terms of outlook, here's the key point, that they're going for a pre-COVID adjusted operating profit margin of 4.5% by March of next year. And they say this financial performance that they're reporting today reflects that aspiration. So very encouraging. So remember what they've achieved in the most recent financial year to March 2024 is 3.8%, and they're trying to get back to 4.5%. So that is an increase of something like 20% from 3.8 to 4.5. So it's another, excuse me, very significant uplift in profits. And that's purely from margin. Hopefully, we'll get revenue growth as well at some point. Perhaps not in the short term, but in the long run, hopefully, we will see that too. So a little CEO comment here. I'll just finish with. He says, we have delivered another year with significant improvement in profit and margin. And looking ahead, whilst the external environment remains uncertain, we remain confident that our strategy is the right one and that we will achieve our aspiration to return the group to pre-COVID-19 adjusted operating profit margins by the 31st of March 2025. So it's a turnaround story that is working, succeeding, and looks like it's got real momentum behind it. Is everything priced in now? Well, I don't think that. Now this is just my opinion, but I would expect that there's more to go here, because if they do get 4.5% adjusted operating profit margin on $800 million of revenue, that is $36 million of adjusted operating profits, versus a market cap of 158 million pounds. So, if the market starts to give this a decent earnings multiple, and if the momentum continues, then I don't think that this is the end of the good news for shareholders. But of course, the future is uncertain. The company itself says that, but I am positive on this one, and I think I've been generally quite positive on it, so I don't need to change my view on it today. So well done to anybody holding this one. So that is IG Design. Okay, let's do where we go next. We'll do McBride, because it's the same theme. Again, this is one that myself and Paul at Stockopedia have scratched our heads over a little bit. I was quite negative on it because I viewed it as being highly commoditized products from McBride. So they make all these household cleaning products for supermarkets that are sold under their own name. So it's very cheap household cleaning products, basically. And I just thought it was very, very highly commoditized. Now, I also could make the same argument about IG Design. I could say, well, wrapping paper is a commoditized product. But I suppose in the case of McBride, I just thought that they had such little pricing power compared to the supermarkets that I was kind of turned off it. But in hindsight, I didn't give the company enough credit for the turnaround. And now the shares haven't really moved today, as you can see from this. But if you scroll and look at over the past year or the past 6 months, this share has been a genuine multi-bagger. You can see it was about 40p last autumn. So we're up at 111p very, very quickly. So going to show the power of a turnaround. And the trading update, it does say ahead of expectations here. And basically, they've pushed through their input cost increases to the customers. And I suppose that is something that you would expect, that they would at some point be able to do that. I suppose the other difficulty with McBride is that they were carrying quite a lot of net debt. And that was one of the reasons that I was skeptical and maybe somewhat bearish on this stock. And in hindsight, I was wrong. To be, I had a negative view on the stock, and the stock did very well. So I was wrong. I put my hands up. But I suppose I was very cautious of the debt position here. You can see that they're expecting net debt of 132 million pounds according to broker forecasts. So that is, that's a significant number. But thanks to the recovery of profitability, we have a very respectable leverage multiple here of only 1.6 times. And again, if you're a regular on the show here, you'll know that that's a kind of number that I think is very reasonable. So profits have recovered, and therefore the leverage multiple has become quite reasonable. Also, net debt has reduced. So they've basically, this is another success story. It's a multi-bagger over the past few months. Will it keep going? Well, look, I am a little bit biased against McBride. I do prefer IG design. And so if I had to pick a stock in this theme, I think IG design would still be my preference. But I cannot deny that there's potential value to be had here. According to Stockopedia, this one is trading at 6 times earnings. You can see that they've got volumes up 6.5%. They've got group revenue up 8%, benefiting both from volume growth and pricing actions. So they've totally survived the inflation problem. You can see input costs for chemicals and packaging remain at similar levels as at our last update in February. So I know that's only a month or so, or 2 months, but some evidence that inflation has cooled down and that prices aren't rising currently. But at least for those input costs, they do say employment, general, and financing costs are still inflationary, so fair enough. But basically, I think the inflation problem has definitely cooled down a lot for them, which was the source of their difficulty a year ago. So well done to anybody who held this. I was wrong on this one, and it's very important to admit when we are wrong. And this one has worked out very well, and it may keep going because at 6 times earnings, why not? I still don't view it as a super high quality company by any means, but at 6 times earnings, it's not priced for that. So well done to anybody who's holding that one. Okay, now let's look at something quite different. Global Ports Holding. I've never really looked at this one before, but it's the world's largest cruise port operator, and market cap 164 million. You can see the shares are up by 8% today. And I thought it's quite curious what this company does. I had a look at its historic financials this morning, and it's never seemed to make a meaningful profit, which I thought was kind of, disappointing, obviously. But then I also noticed that they've never increased the share count, at least not recently. So for a company that's making losses and not raising money, how do they survive? Well, by increasing their debt, and their debt has been going up and up and up. And you can see here that they've got gross debt of $598.6 million at the beginning of the current financial year. Oh, excuse me. Excuse me. What is this? Sorry, this is the old. I'll have to use a different source to get the latest RNS on this one. But basically, this company has racked up its debt significantly over the years, and I'm very curious to see how they're going to ultimately figure this out. How they're ultimately going to deal with that debt as they keep building it. So I have the latest number for you here. Net debt, excluding leases, of $581.5 million. So that seems quite an extraordinary level of debt, given that the market cap is only 150 million pounds. It remains loss making. So I really don't know how this one is going to ultimately prove to be a success for shareholders. Just been scratching my head over it today. They've got ports in Puerto Rico, the West Indies, and various other ports. It's a decent sized company, but yeah, if anybody has any, can anybody present the bull case for me on this one, because I'm certainly struggling, and the outlook also is rather difficult here. They say the global cruise industry has shown resilience, but high inflation and rising interest rates globally have led to an uncertain economic outlook. And but they say the longer lead time on cruise bookings compared to land-based tourism provides significant protection to the cruise industry during periods of macro stress. So anyway, I've been struggling to understand this one. I struggle to see an investment case, but it did pop up on my radar this morning. I thought I would take a look at it, and I'm certainly open to hearing a bull case on it, which I can't find myself right now. Okay, let's move on from this one and do Card Factory. This is always very popular among private investors. You can see the shares are up by 6.5% today. Big company by our standards, market cap 370 million pounds. So yeah, this is a very familiar brand. I see it myself from time to time when I'm out shopping, and it always seems quite busy. So today's update is positive. Expectations are unchanged, and big news here that they are allowing for the resumption of dividends thanks to a strengthened balance sheet. So yeah, these full year results you can see are very positive. Lots of things moving in the right direction, including net debt falling from 57 million pounds to 34 million pounds. And if you did a net debt to EBITDA multiple on that, you would get something very small, because EBITDA is 122.6 million pounds. So absolutely no balance sheet concerns there, at least in terms of that metric. Of course, there will be leases to consider as well. But very, very satisfactory results here from Card Factory. Revenue up 10%. Like-for-like revenue up 7.6%, driven by a strong store performance and positive traction in online. So yeah, very little to dislike here. Pretty much all good news. Now, granted that it's in line, so there's no upgrade, but yeah, I'm not sure if there's much more to say on this. In terms of capital allocation policy and refinancing, I do always focus in on this aspect of company strategy. So the point is that they are no longer restricted from paying dividends because they've got their COVID loans paid off. They've got a new credit facility, which I don't think do they really need 125 million pounds? Maybe they do for seasonality reasons, but that certainly seems like plenty for them. They have an updated capital allocation policy which reflects our commitment to balancing investment in driving the growth of the business and delivering cash returns to shareholders. And so they're starting off with a 4.5p dividend. So let's just remind ourselves where the share price is. 107.6p currently. So 4.5p getting paid out for this most recent financial year. And a target leverage of below 1.5x throughout the financial year. So the key point there is that due to seasonality, there will be big swings. There could be big swings in the cash balance and in the net debt levels. So what they want is to ensure that they get this 1.5x target met, throughout the year, even during seasonal swings. So that's an important point and sounds reasonable and possible. Current trading has been in line with expectations, with continued positive momentum across card, gifts, and celebration essentials for Valentine's Day and Mother's Day. And they had a record trading day on the Saturday before Mother's Day. And then the outlook statement, they are confident in their long-term compelling growth opportunity and in the company's ability to deliver on the medium-term ambitions of £650 million of sales, profit before tax margin of 14%, and 90 net new stores by the end of FY27. And can I just point out that this profit before tax margin of 14% that they're targeting is a very, very decent number, and it kind of shows the benefit of investing in a company that is B2C, selling direct to a consumer, where these margins are possible, rather than getting squeezed in the B2B world. So an excellent profit before tax margin that they're targeting, and £650 million of sales. Will we just scroll down to the financial statements briefly? So you can see that what they achieved in the most recent financial year was £510 million. So within shouting distance of that 650 million, but still some ways to go. And the profit before tax was 65.6. So 65.6 means that they had a profit before tax margin of 12.8%. So again, within shouting distance of their target of 14.5%. So these targets are certainly seem realistic, and they could get there before too long. They will need to open some new stores, but hopefully the market can sort of take that level of additional supply. So yeah, very nice update from Card Factory, and I hope you can see the theme here between Card Factory, McBride, and IG Design. We have this theme of companies that struggled in a period of high inflation and coming through and enjoying sort of the post-inflation turnaround, where they can pass through price increases to their customers. Inflation for them has cooled down a bit so that their own input costs are no longer rising as quickly, and margins are recovering to pre-COVID levels. So excellent news here from all of those three companies I've mentioned: Card Factory, McBride, and IG Design. So Card Factory shares up 6.5% there. So even though it was an inline update, the market definitely did like that result. Okay, let's do if we've got some time for North Amber, just a funny little share. I don't really understand why this share price is up today, up 14%. This is a company that I used to own, and I used to go to the AGMs, basically a value trap. Being a trade-only distributor of IT equipment, when the industry doesn't, it's kind of moved on, and these distributors are sort of, they're sort of old-fashioned, and there doesn't really seem to be any, economic reason for them anymore. But anyway, North Amber shares are up today, very strangely, on the announcement of a £6 million acquisition. Now, bear in mind, market cap here is only £10 million. The net asset value is significantly higher, but the market cap is only 10. So for it to announce a £6 million acquisition is a big deal. The book value here is about £23 million. So they probably can afford this, especially since they're only paying £3 million in cash, with some shares being issued, and then contingent consideration or a DEFCON coming afterwards. So they're buying another distributor, a distributor of unified communications, which has a track record of organic revenue growth, profitability, and international operations. So I suppose what might be happening here is, the share price might be up today because people may actually think that North Amber could become, a growth business now. After many years of no growth, maybe they're going to buy a little bit of growth through this, and that will sort of change the profile of the business. They say the enlarged group will have a strong services focus as a technical distributor with strong gross margins. The acquisition will diversify the service offering of the company through expansion into complementary markets, provide cross-selling opportunities, provide a highly scalable business model, and enhance EPS. So they've certainly done a good job of sort of selling the deal. But it's if it's only costing £3 million, it can't be that big of a business. You can see here that based on management accounts for last year, this business being acquired had revenues of 14.6 million and PBT of 0.8 million. So very, very low margin, as you expect in the distribution business, but at least they do have that small element of profitability. And if that comes into North Amber, then I guess North Amber starts to be a business that could generate small profits in the future. So best of luck to them. I have no temptation to get back involved in North Amber again, but I know there are some highly esteemed value investors who do like to follow it and who do still own some shares in it. So hopefully this will work out reasonably well for them. Okay, so we're kind of in the we're in this other category of shares now where things aren't working out quite so well. Rosenblatt Group. Now I think it's actually changed its name to RBG Holdings, but I still think of it as Rosenblatt. Market cap is only 13 million. Shares are down 19% today, and I suppose this share kind of highlights an example of where I get nervous investing in law firms. I find that law firms, they're so labor intensive, a people business. It is difficult to build a valuable brand, in terms of that, that consumers are going to recognize and it's just not in a sector that I really like. But you can see that today's results from Rosenblatt are sort of highlighting an example where it's just not really working out for investors. We've got a big stonking loss of £11 million. Bear in mind the market cap here being only a little bit higher than that, £12 million. So very big loss, and net debt of £23 million with cash of 1.4 million. So look, it's not a reflection on the company as a workplace or a reflection on the value it provides to clients, but as an investment, I would have to say that that this is highlighting for me why law firms are sort of dangerous territory. And but a lot of the time with law firms, what you end up with is a business that has no tangible value. It has very low margins. A lot of the value gets taken out by the staff, and then eventually it ends up in debt, and the staff either start a new business or there's a restructuring and it just starts again with new shareholders. So hopefully that doesn't happen here, but unfortunately I wouldn't have any temptation here. I'd also like to point out that they say this. They say that trading during the first quarter of 2024 has been in line with expectations. They also say, ignoring the impact of the unusually large piece of work that ran in 2022, legal services has traded slightly ahead on a like-for-like basis. Now, look, I'm not trying to sort of make a huge deal out of this, but I just have to point out that this is not on a like-for-like basis. You can't just ignore the impact of an unusually large piece of work. Law firms have unusually large pieces of work. I think that's fair to say from time to time, and I would point this out whenever any company says, excluding this thing that happened, we've grown, when actually they're not growing. I always point this out when a company does that. So I have to do it again here to be fair. So anyway, good luck to anybody involved in this one, but it's a no-go for me, I'm afraid. So that is RBG. Now we've got another company that I wanted to mention because we have a buyback possibility here. So Pebble Group strikes me a bit like Altitude, although I guess it's bigger than Altitude. Let me just check how big Altitude is now. So Altitude ALT, market cap 22 million. Pebble Group significantly larger at 96.7 million. I just mentioned them in the same breath because they've got this idea of focusing on the promotional products industry. And this they've got these two businesses. I was looking at Facilis Group this morning. Very sort of powerful software, I think. They say that it provides customer relationship management, sales, ordering, product search, accounting, reporting, training, marketing, the whole lot. So you can run your entire business with this Facilis Group product, and then they've got this brand addition as well. Anyway, Pebble Group shares are up 5% today, market cap 97 million, and we've got this AGM trading update, and they say a share buyback program is planned to launch immediately. So I always sit up and take notice of buyback announcements, and I think this could be pretty exciting. Now, how big is it? A maximum aggregate consideration of £5 million. So that is material. That's potentially 5% plus of the share count, which means a significant boost in earnings per share just from that 5% reduction in the share count, which they could achieve. They say in terms of the outlook, we remain early into the current financial year, but trading is progressing in line with market expectations, and they see attractive opportunities for both of their businesses. So nice announcement there from Pebble Group, and I would agree that the share price probably should be going up in response to that announcement. Let me just check some value metrics on this one. So according to Stockopedia, it's trading at 11 times earnings. You can see here on Vox, it's trading at 13 times last year's earnings. So not too high of an earnings multiple, you could say, and over the long term, revenue seems to be going in the right direction. I would say that one is worth researching in a bit more detail, especially if you like buybacks, as I do. Okay, now what else do we have to look at? Let's go over to the Vox homepage and see what people are reading here. We've got Avacta Group full year results, most read RNS. Card Factory is on the list of most read. Poolbeg Pharma's in there. Greatland Gold. In terms of risers and fallers, you can see IG Design up 35% is on the list. James Cropper up 28%. Webis, that's a tiny company. Let's see the current market cap here, 5.6 million. Yeah, so that's just a tiny company. We can't read too much into double-digit share price movements when it's sort of a 5 million market cap, in my opinion. But there's the big risers anyway. Global Petroleum Limited up 75%, but again, this is a tiny company here, market cap 3 million, so not of great meaning. And then we've got the fallers over here, including Acensus. So let's click on Acensus, down 28%. So this is a leading provider of mission-critical SaaS platforms and on-demand cloud services to the high-growth flexible workspace industry. I did have a little look at this company. I'm not familiar with it before, but I've been trying to get a handle on what they do. So basically, letting people with commercial tenants to sort of manage these shared and flexible workspaces. Unfortunately, looking at its financial history, it's never seemed to make a meaningful profit up until now. Let's see what we've got in the archives here. Okay, it's been mentioned a few times in the archives, but unfortunately, it's never seemed to make a meaningful profit, and that's going back a few years now. And today's update, which sees the shares down by 28%, I think financially it's more of the same in terms of losses. Okay, a smaller loss than the previous year H1. But net cash only £3.5 million, so that's a big fall. So even though they are debt free, that's not enough to be comfortable. If if they're loss making and if the cash balance isn't that big, and if you're not confident that they're going to make a profit or at least a break even. So I mean, they do talk about making cost savings, so that's some comfort. Um, and yeah, so down at the outlook section here is where things do look quite bad, to be honest. They've got a large customer moving away, resulting in the loss of up to 90 sites. So that's a reduction in ARR from two different products or ways of selling the product. And they also say down here at the end that whilst recurring revenue continues to track in line with management expectations, full year revenue will be below expectations due to lower than expected non-recurring revenue as customer CapEx budget pressures persist. Yeah, this is not looking great. I mean, the cost savings suggest that maybe they pull through, but and they say they are on track for positive adjusted EBITDA and for net cash generation, but there's not a huge amount of headroom there. When you're down to £3.5 million of cash, maybe they could, maybe they could go into net debt for a while, and that would be fine. But you wouldn't feel comfortable with that as an investor, I don't think, given the track record here. And even when they say run rate positive adjusted EBITDA from Q1, okay, that's better than making a negative adjusted EBITDA, but it's not really an assurance of the cash balance. And they do say they will have net cash generation, but this is one of those stocks where I think they have a lot to prove. They might do it, but they have a lot to prove. So that is Acensus. And okay, folks, we're about 53 minutes into the broadcast. Very busy day for updates. Sorry I wasn't as interactive today as I like to be, but please do hit me with your comments under the replay if you're watching this on the replay. I do try to learn from your insights, and please hit the like button on your way out. I really appreciate that. And I will be back tomorrow, hopefully at 12:30, as close as possible this time. So thanks for all your company. Thanks for dropping by, and enjoy the rest of your afternoon. Okay, thanks for that. Bye, everyone.